Good afternoon, everybody. Good afternoon. For those of you who know me, you know I'm Francisco Sirvent with Keystone Law Firm. For those of you who don't know me, welcome. I'm Francisco Sirvent, estate and tax attorney here at Keystone Law Firm and financial advisor with Lifestyle Planning. We have more content than we could hope to put into a quick webinar. This one big beautiful bill is the topic of hundreds and thousands of hours of research that are going in to try to understand its impact in my industry. So I had to pick and choose what I thought would be most helpful and relevant for you guys. And so we're going to hit on what I think are the biggest 5 things that impact my practice and the people that we take care of. Before we dive in, I definitely want to welcome you guys. We're going to be here about an hour. I have a hard stop at 1 o'clock. I'm going to save a little time at the end for questions. I am recording this. We are going to share all of these webinars on our YouTube channel, so that's where you'll be able to find a replay of this if you want to watch it again to try to hear things a second time and maybe understand a concept a little bit better. So with that, just know it's being recorded, and like I said, it's going to be shared. If you prefer to not be on the recording, you can click your video, turn it off. You're also welcome to drop off entirely and then just watch the recording. But the fastest and easiest way for us to get these up and out to everybody is to use that system. For those of you who don't know, these are all the legal notices that we need to put out there regarding everything that we share. This is obviously not specific legal advice, not specific tax advice, not specific financial advice for anybody's personal situation. This is general information of an educational nature. So definitely, if you see something here, you learn something, and you think, oh wow, I need to do that, double check it with your advisor in whichever category makes sense so that you make sure it fits for you. I hope this raises some issues for you to think about. Maybe you'll hear some things you haven't heard about yet from the one big beautiful bill and prompt you to take some action, because I think the best thing about this is finding a nugget here or there that you can go, I got it, I can use that and actually make your situation better. So there you go. I'm sure you read all of that. Let's dive right in. The first one that I think is probably the simplest and easiest to implement, the easiest to understand and make sure you take advantage of, is this bonus senior deduction. Okay, so this applies to people who are 65 or older, and you get it for this year if you're in that category. But what does this mean? So if you remember from 2017, the Tax Act that went into place in 2017, there was a whole bunch of extra goodies in there for all of us. One of them was the standard deduction went up a lot, and it was different for single people versus married or head of household, etc. But we all got this big standard deduction, which essentially made it irrelevant for most people to itemize deductions on their tax return. So instead of reporting what your mortgage interest and your charitable gifts and all these things were, and having to itemize and keep all the receipts and all that paperwork, the IRS just gives you a bigger standard deduction. So for single people, it was this year $15,750. Head of household, $23,000 about, and for married filing jointly, it's about $31,000, and that's regardless of your age. So that just is a deduction you get. You don't have to prove anything. You just, if you were married filing jointly and you had income less than $31,500, you just wiped out all your income. So that's what we had in place since 2017. That was set to expire at the end of this year and go back to all of us itemizing deductions. So that was extended. Okay, so all of that, the bigger standard deductions, those are now in place, and they're going to be indexed for inflation. IRS has to publish what those numbers are each year as it goes forward. They apply an inflation factor and round it to the nearest round number. But those standard deductions is one of the changes. So those are all in place. What has also already been in place is that seniors 65 and older also got an extra $2,000. So that's always been in place. So, or since 2017. So you still get that extra $2,000 deduction if you're a senior. What's new is this bonus deduction, and that's the $6,000 extra deduction for those who are 65 and older. So that's not a small deal. I mean, $6,000 deduction, if you're in a 20% effective tax rate, that's going to save you $1,200. It's going to literally put $1,200 back in your pocket. So here's how the math shakes out. If you're single and you're 65 or older, you get the standard deduction, you get the senior deduction, and you get the bonus deduction. So your total standard deduction will be $23,750. Not bad. If you're head of household, you get the standard, you get the bonus, and you get the $6,000, so $31,625. Where it gets unique is if you are married, okay, and one of you is over 65 or 65 and older, you get the standard deduction, you get part of, there's a reduction in there, so you get part of the bonus, but you do get one full senior deduction. But if you're married, you get two of those, okay? So it's one per person. That gives you a total tax-free income of $46,700. So look out for that when you're doing your tax returns this year if you're 65 or older. Okay, that's the first cool trick. I like that one. The next one that I think is really helpful are these Trump accounts. You know, this is brand new. I've never heard of this being done before. But guess what? If you have a child or a grandchild that is born between these dates, okay, so basically it's the tax years 2025, 26, 27, 28, or 29. So those 5 years, and then it sunsets. Anybody born during those years is going to literally get $1,000 deposited into an account by the federal government. It's a retirement account. They are built just like IRAs, kind of like 401ks a little bit, but it's an individual account for that person born in those years. So they're little, they're teeny. So exactly how the structure is going to work, exactly, you know, the parents need to be in charge of the account, et cetera, and how the federal government's going to deposit it in there, those are still things being worked out. But they have to work it out because it's law now. So $1,000 right off the top. No withdrawals before the age of 18. Okay, none. Okay, there's no withdrawals. Family can contribute up to $5,000 per year to that account in addition. So you don't have to, but you can. So $1,000 starting balance, you can get it literally at age 0, and you can contribute $5,000 a year. Grows tax deferred, just like an IRA. Okay. When they turn 18, it converts to a regular IRA. Now, unlike a regular IRA, you can only contribute to an IRA if the account holder is earning income. It's the only way you can contribute to an IRA. There's other rules too, but one of the main factors to eliminate it working for kids is that kids generally don't earn much income, if any. And so they can't start an IRA when they're young. This blows that out of the water. So when they're babies, you can now open an IRA for them, get the $1,000 in there, and anybody can start contributing into that account for their ultimate retirement. No withdrawals before they're 18. It grows tax deferred until they're 18, but it continues to grow tax deferred after that. And after they're 18, So from 18 to 59 and a half, you don't want to take withdrawals because they would have a 10% penalty on the withdrawal. So now there are some exceptions, like there always have been for IRAs, medical emergencies. There's a certain withdrawal you can take for first-time home buyers, things like that. But those withdrawals are still going to come with the withdrawals being taxable. So it still applies a lot like a IRA. And I was curious. I'm like, well, geez, what does $1,000 turn into if you just let it sit and grow? And so I ran some rough numbers. And basically, if you let it, if the government put $1,000 in there, you didn't contribute anything else, you just let it grow 5%. When they're 60, it's going to be about $20,000. Not a life-changing amount, but it's free money, right? But if it grows at 8%, it grows almost to like $115,000, which is pretty cool. So I know I'm telling everybody that I hear who has a baby now or in the next 5 years, get this account open, find out how to do it, get your free $1,000. And actually, you know what? Since it's a free $1,000, just invest it like in a really aggressive but very diversified portfolio and let that thing grow for 60 years. It could grow to a whole lot more. If you were able to capture 10, 12, 15% average growth rate, this can turn into a multiple $100,000 account for their retirement without any more contributions. So this is a huge, huge win, I think, for babies born this year. I think it's a pretty interesting idea, to even create this kind of program, because if you think about it, it's like there's all this talk about Social Security. There has been for decades. Social Security is not going to be there when you need it, et cetera. And there has yet to be any proposal from any politician to actually eliminate Social Security, but there's talk about it, right? This is an interesting thing, because if you take $100,000 and put it in an account and keep the government's hand out of it and let it grow for 60 years, it potentially could be a really important beginning balance for somebody's retirement. And maybe this is a step in that direction. I don't know. But because the government's hand isn't in it, I'm in favor. All right. Something else that's a little bit more complex, but is a really big, big deal for, I think, for everybody. It's a very obvious benefit for people who have businesses, real estate investors, people who are self-employed, things like that. Like if you're already running a business or you're a partner in a business, you have rental properties, or you're self-employed, I think this is a huge, obvious strategy. And I think this does give a lot of strategic options for people who don't have a business. They're not entrepreneurial, they're not real estate investors, et cetera. They work for somebody else. They're a W-2 employee. There's some really important strategies that you could take this and save a ton in taxes. So what is depreciation? Just to kind of give you guys a little foundation here. So essentially, depreciation is the way that the tax code lets a business deduct something they buy that actually has a longer lifespan than 1 year, right? So businesses have all kinds of expenses, and the government, there's a general policy for a business to not be taxed on their expenses. If you have $100,000 in income and you have $50,000 in expenses because you had employees or office space or whatever, the policy is we're not going to tax you on that because you had to spend that in order to produce all that revenue. So we're only going to tax you on the profit. Well, a lot of businesses have to buy things that they're going to consume this year. Like we buy lots of paper. Well, we're going to use it, right? We're just going to use it this year. But we also buy things that are going to last 5, 10, 20 years. We buy furniture, we buy computers, we buy all kinds of things that are going to last well beyond that year. And so initially, the way the tax code is set up was, hey, if you buy something this year that's going to last you 5 or 10 or 20 years, you only deduct a portion of it each year. Okay, so if it's going to last you 10 years, theoretically, you deduct 1/10 of it each year, even though you paid for the whole thing in the first year. So that felt a little unfair. So they changed it, or they implemented a thing that says, look, yeah, you spent all the money the first year. It might have a life of 5 or 10 or 20 years, but we're going to let you take bonus depreciation to depreciate all of it in that first year because you bought it in that year. And so it's kind of like accelerating all that depreciation into 1 year. So, we buy a bunch of computers 1 year, they're going to last us 3, 4, 5 years, but we can deduct them all in 1 year. Why this is a big part of the big beautiful bill is that this 100% bonus depreciation law was, the way it was built out over the last, 5 or 6 years was, first it was 100%, and then the next year it went to 80%, the next year it went to 60%, the next year it was going to go to 40%, and it was going to decrease so you weren't going to get it in 1 year. Well, this changed that so that it is 100% in the year that you put that purchase into service in your business. And that's permanent now. So businesses, and there's caps and limits and things like that, but generally it's 100% if you are within those ranges. So what does this mean for you guys? It can mean a number of things. So I'll give you an example of a business owner just to kind of let you see how this works in a typical scenario. Business owner, small business, maybe like a small accounting practice or a small private doctor's office, something like that. They might bring in total revenue of whatever, but then they have all their regular expenses, and maybe their net income off their business is $250,000. So essentially that's, what they would otherwise declare as their taxable income is $150,000. And generally speaking, $250,000. And if there was no bonus depreciation, if there was no bonus depreciation, that's what their tax would be charged against, $250,000. They'd be put in that tax bracket. Their effective tax rate would be a much higher number. But because they can take their bonus depreciation of something they bought, maybe they bought a new piece of equipment or a series of furniture, or they did some remodeling in their office, they have $100,000 in expenses that they would have otherwise had to spread out over 5, 10, 20 years. They can take it all that year. And that brings their net income down to $150,000. So that changes what tax bracket they're in. It changes their effective tax rate. And the bonus depreciation for this simple example literally saves that business owner $27,000 in taxes, in just federal taxes, in just 1 year. It's a big difference. I mean, if you look at their net income of $250,000, that's almost 10% of that net income. So that's just kind of a simple business, like small business example. Two other examples that might apply to some of you here or other people who might watch this recording are somebody who's a high income earner. They're not a business owner. They're not a partner in a company. Maybe they're a doctor. Maybe they're, one of the AI software guys that's getting recruited and getting paid these amazing salaries, and their W-2 net income after the couple deductions they get, say in this example, is $500,000. Okay, normal life, that $500,000 is going to put them into the highest tax bracket, right? I think the highest tax bracket right now is like 37%. And so their tax bill on that $500,000 is actually going to be about $230,000. Their tax bill, ouch, right? But they can put together a strategy, and I'm going to go through these in just a second, but they can put together a strategy where they can get a deduction of $250,000. And I'm using that number because they can use any number, but say they do a bonus depreciation deduction of $250,000. Then their taxable income is the difference, it's $250,000, reduces their tax bracket, reduces their marginal effective tax rate, and in that example, they save $87,000 in taxes. It's not a small number again. Or we have a lot of clients who are sitting on either a business that they're selling and they're retiring, or they are maybe sitting on some stock that they've held for a long time and it's got a lot of capital gain in there. And they're like, if I didn't have to pay all these capital gains taxes on this, I would definitely get out of that and maybe diversify a little bit or do something else and maybe get things that might not be as risky. But they've got a lot of capital gains built into there, so they're not doing it. Well, in this example, they can find something that gives them bonus depreciation. And I give you a really extreme example of this person of finding a strategy that gives them a $650,000 bonus depreciation deduction. That's what's interesting about this deduction is there's no limit. There's no cap. There's no, like, you can really get a lot. I just got off the phone with somebody yesterday afternoon. He's doing a $5 million bonus depreciation strategy. He's going to save himself like $2.5–3 million in taxes. So in this example, brings the net income down to $100,000, brings them down into a 14% effective tax rate, and puts over $200,000 in taxes back in their pocket. So how do you do this? There's a bunch of creative ways out there. And because this is the new law, you're going to start seeing ads. You're going to start seeing companies promote this. It takes some due diligence to figure out if it's going to be legitimate, if they've done it before, if they've been audited on that strategy before. And so, don't jump in both feet without doing that due diligence. But there are some really easy and clean strategies that have been around for a long, long time. One of them, a bunch of our clients are using this year, is the solar tax credit. So you don't do this unless you otherwise have a pretty significant tax bill, in the neighborhood of $100,000 or something more than that. But the way it works, this has been around for a while, and it passes the audit test, and it's not like some tax scam that's going to end the lawyer and the CPA up in federal prison. No, but the way it works is tax law says if you invest in solar, you get tax credits for doing so. Okay, so there's a big tax credit, which isn't a deduction, but that's an extra bonus. You get a tax credit. But then also, because you're putting a business in place and you're putting business equipment in place, you get this bonus depreciation. Okay, so it's a double tax strategy with the solar tax credits. And the way the math works out on a lot of those solar tax credits is if you put $100,000 into one of those, a lot of times in the first year, you get like a $100,000 or $150,000 return on your tax dollars. It's a huge benefit. So solar tax credits are something that's very complicated. You have to have a lot of moving pieces. You have to be willing to deal with a lot of moving pieces. They can get set up very quickly, but it's a lot of moving pieces to get set up. It's a huge tax benefit. Another one that's been around for 100 years is putting money into working interests in an oil and gas investment. Highly speculative, highly risky. You don't just go, find some dude who says he can do it and give him money. Lots of due diligence to be done there. But oil and gas has also a secondary tax component that makes it kind of supercharged. You get your bonus depreciation, but because it's considered a working interest under the tax code, you get another deduction. And so you get big tax benefits by making investments that essentially the government wants to incentivize. And so solar is one, oil and gas is another, and you can literally leverage up your tax dollars, and instead of writing the check to the IRS, you write a check to an investment that you own. And yes, you own those, and then over time they pay you money back, and over time you can sell and get out of those. There's a lot that goes into them. You don't do those without being very familiar with what's happening. But those are a couple things that actually can reduce these tax bills hugely. So if you hear anybody who's complaining about a big tax bill, or doesn't even know that they can reduce their W-2, make sure you tell them about these couple things. They can do it. This bonus depreciation was a huge incentive to reinvest your money, put it back into service, and actually get tax benefits for yourself. So that's the bonus depreciation portion. Charitable giving has a slight change that I think is I love it. I love it. I love tax incentives that promote things that you would otherwise either already be doing, or we want society to kind of invest in, right? So charities, we hope they do good things out in the world. And what's the one? Charity Navigator, I think, is a website that does a lot of good evaluation of the bigger charities out there to see how they're spending the money. But there's this, so back us up a little bit. Remember, we talked about the standard deduction, right? So we all have these bigger standard deductions now. And what that did is it actually, and I think partially why this is now coming back, is that standard deduction meant if I gave 1,000, 2,000, 3,000, 4,000, like if I gave to charity some dollar amount that was less than my standard deduction, I didn't get to deduct anything more. Okay, like I'm married, we take the married standard deduction, 30-something thousand. Well, if we gave 5,000 to charity, we didn't get 35,000 deduction because that was below my standard. And so I have wondered over the last few years if there's been less gifts to charity because there's no deduction for those amounts. And so now the law has changed. You get your standard deduction, the full standard deduction, and if you give $1,000 to charity, you get to deduct that $1,000. Okay? If you don't itemize, that's on the don't itemize column. And if you're married, it's $2,000. So I think this was put in place to kind of incentivize us to get back to giving to charity, because maybe that has dropped off these last few years. If you do itemize because your deductions, your personal deductions are more than the standard deduction already, and you do itemize, then what happens is there's a reduction of your charitable giving by 0.5% of your adjusted gross income. So you have to go through a calculation, and your CPA would help you do that. But there's this little reduction. So if you don't give more than that 0.5% of your AGI, you don't get to deduct any. So an example, married couple gives 5,000 to charity. They use the standard deduction. They can only deduct an additional $2,000. On the other hand, if you do itemize, a married couple gives 5,000 to charity, they itemize, that $5,000 number is going to get reduced by 0.5% of their AGI. So if their AGI, let me just confirm my math before I try to do it in my head, times 0.005. Yeah, so if their AGI was $100,000, 0.5% is $500. The $5,000 charitable gift will get reduced by that $500. So the reduction is based on each individual person's AGI. So it requires a little bit of math to figure out. But that's the new charitable giving. So again, it's incentivizing us to not itemize. We still get a little charitable deduction on top of it. All right. And then the big one that is really, really my unique industry is the estate and gift tax exemptions. So we talk about this with all of our clients. It only applies to some. But if you look back at the law that was in place before this act passed, it said that starting January 1st, 2026, what was going to happen after that is the estate tax exemption was going to expire and go back to the law that was in place before, which meant that a married couple would have a coupon of $12 million that they get to leave to their heirs estate tax free. That's the exemption amount. So it would have been $6 million per person. A married couple gets to combine it. That's what the law said it was going to be. And that's a bigger portion of the population than what the law is now that this act passed. This act says that it's now permanently going to go forward like this with every year indexed per inflation. And so 2025, we were at 15 million and the law says it's staying, but then next year it's going to go up, and it's going to go up by the amount of inflation. So the IRS will do that math and publish those numbers next year. So now we have a $15 million per person or $30 million for a married couple that's estate tax free to your heirs. And again, the exemption amount is the first coupon. Anything on top of that is 40% estate tax plus whatever income tax is due on any IRAs and 401ks or qualified annuities that get distributed to your heirs. So the amounts on top of the exemption are taxed heavily, 40% estate and maybe around 20 or 30% income. So if you had $40 million, you'd have $10 million that could be taxed at 60, 70% when you die. It's a big tax bill. Here's the problem with this law, with the estate tax system that we've always had a problem with. The problem is there's only two ways to use the exemption amount. The first one is what? The first way is you die the year of the exemption. So that is not something we necessarily have control over. It's not something we can capture right intentionally. So that's how the estate tax exemption is applied. It's applied whatever year the exemption, whatever year of death, that's the exemption that year that applies to you. That's the first way. The second way is you make a gift, because the estate coupon and the gift tax coupon are the same. And so as you use your gift tax coupon, it applies and reduces the coupon that you have left in the year of your death. So for example, if this married couple had $30 million and they gift $15 million into a trust for their kids, then they've used, maybe one of them made that gift, that one would have used up their entire 15 million exemption. If then that one dies, and that's what the exemption is the year they die, they have no more exemption, okay? So you use your estate tax coupon by making gifts. You don't use your estate tax coupon when you make gifts during your life under the annual exclusion amount. You know, we can all make gifts to anybody. It's, I think, $18,000 right now. So if you're making gifts under $18,000, that does not use your gift exemption and it does not deplete your estate exemption. So that amount you can continue to do as much as you want. But if you give more than that, it uses your gift exemption. So why am I saying this is the second way to use this? Because Congress can change this law anytime they want. We all know that. And if they do, and they want to reduce the exemption coupon, it's a really easy way for them to, you know, grab tax dollars. The worst example in my case that I've seen was, not that I've seen, but that was personally for a client, was actually a lawyer who passed away. And she had done no planning whatsoever. And the family literally had to, the year of her death, had to liquidate enough of her stock and real estate and other stuff in order to write a check of $3 million to the IRS. It was just a painful thing because they had to sell stuff not necessarily when the market was the right time. So they were selling things when it was low, and it just had to get the cash and write a check for $3 million. Congress can change this law. So you can capture this exemption by doing gifts. And that's the strategy. That's the main component of the strategy for people who are in the category of needing to maybe be a little concerned about the estate tax. And you do gifts, generally speaking, of the dollar amounts we're talking, that $15 million. You're not writing checks directly to people. You're not giving checks directly to anybody. You're giving them to specialized kinds of trusts that you still are in control of, you still manage, you still even, do the investments and whatever. You're in control of that. And you decide if there's any distributions going to anybody while you're still alive. But you've essentially locked in and used the coupon so that if law changes in the future, if they reduce the exemption, it can't go back and undo what you've done. You're grandfathered in. That's how you capture the estate exemption with current tax law, even if it might change in the future. So that's, it's a great thing. There's a lot of clients we can help with that, but it can change. And so that's the idea: is you make a gift, you capture the exemption, and then you're protected, right? If the exemption goes up, you can get more, you can use more. But if it goes down, you're not affected, you're grandfathered in. The other reason why I bring this up, this doesn't affect most of our clients, but here's the thing. It's starting to affect more and more. So, when I was a young attorney, I didn't really think of this, but coming up on almost 20 years of practice, more and more of our clients started with us young and they've grown their estates. And so as you live, your estate might be growing. And it could just be through things you're passively investing in. It could be through businesses you're working in and growing. It could be through whatever. Maybe you inherit something and your estate grows. That's a real concern, because most of us, we're not looking at our timeline and saying, okay, I've got a year left, right? We've got many, many years. And the younger you are, the more decades you have, the more probable your estate might have time to double and maybe double again. So if you look at general numbers, if you've got an estate that's growing at 6 or 7% a year, that's going to double every 10 years. So think about, what's your number? I don't know, it's this. Well, in 10 years, I'll be this old, and if it doubles, okay? If I live another 10 years, it's going to double again. You go, ooh, I'm actually coming up on that number. That's why we bring this up, because you can use some of that really generous estate exemption right now to make sure that that growth, that future growth, that's doubling, happens outside of your estate. It happens in one of these specialized trusts. So again, you can still grow it, it can still double, but once you put it in there, that growth, that doubling is not part of your estate. So it doesn't get taxed at your death. So just think about your numbers and think about, what would it be? And then say, do I need to do something about this? Because maybe you do. All right, those were the main things I wanted to cover. I want to open it up for questions. I think I did see a couple questions come in, or maybe a couple hands go up. And I want to invite, so there's a couple ways you can ask questions. You can throw them in the chat box, typing. I will allow you guys to be able to turn on your mic. And so you can turn on your mic and just pepper me with questions. Or there's a Q&A button you can hit, and I will look for that as well. So those were the big ones I wanted to cover. I didn't want to overwhelm everybody with tax, and all the minutia that's happening out there. There are a few others that I'll probably talk about in the near future, but those were the big ones that I thought were first and foremost for us to cover. All right, anybody questions about this stuff, about anything we've talked about in the past? I'm open for business, whatever you need. And if you guys heard something here, you think, gosh, that definitely applies to me, I need to figure it out. There's a, I'm happy to give you guys a quick link to jump on my calendar and grab a 15-minute call with me. I just posted that in the chat. You're welcome to do that, and we can talk about it. Let's see. Did I see a hand go up? Nope. All right. If nobody has questions, all right. Let's see. Laura, what do you got? You have to unmute your mic.
Okay.
There you go.
Okay. I was just wondering if you could give us some additional strategies that are either popular or possibly reputable.
Yeah.
Other than the solar or the oil and gas.
Yeah, those are really complicated strategies. Some of the ones that are much more sort of vanilla, very standard, that have always been in place, are still in place now. The first one I always go to is Roth conversions. I always go to that because of two reasons. First, I think there are two ways to look at it, and I think most people who recommend Roth conversions only think of it from one dimension. So Roth conversions are the first thing, and I think the two ways to think of it are: first, in your own retirement, it makes sense from two perspectives. One, the overall tax burden on you is going to be, in my opinion, better. But then the second part that's beneficial for you is the distributions are no longer mandatory when you reach that age. And so that can really give you flexibility on how you access your retirement funds during retirement. So that's the first thing. The second thing is how those accounts get inherited. So an IRA or a 401k that gets inherited has a mandatory distribution period of 10 years. So they have to pull the money out over 10 years, which means they have to declare their distributions as income on top of whatever income they're already earning. So it's going to get taxed in an accelerated time period over 10 years after you pass away. If you convert it to a Roth and then they inherit a Roth, there's no distribution period. Okay, well, there's some arguments in the IRS, but even if there is, those distributions are then tax-free to them. And so you get more years of growth, you get more years of accumulating those assets, and the distributions are tax-free as an inheritance. So I always start with Roth conversions. Some of the things we talked about today give the ability to do a little bit better tax planning for Roth conversions, so that the year you take and convert from an IRA to a Roth, you have a little bit more flexibility to maybe think of some strategies to reduce your taxable income even with an IRA conversion in those years. So we try not to just, do a conversion and, 100,000 moved over and you got 100,000 more in tax. We try to combine it with some additional strategies in that year to offset that 100,000 income in some ways. And so combining some of these miniature strategies with the Roth conversion is still, in my opinion, the first thing to look at when it comes to retirement taxes. One of the other ones on IRAs that I hope you all know about, if you don't, now you know, is that when you get to a point where you're being forced to take distributions out of an IRA, depending on the year, what year you were born and how old you are, but whatever that first year is, a lot of people, they're like, I don't need the distribution, I don't need this money. But they take it because they have to, and now they have more taxable income. And then from their other bucket, they're giving to their church, they're giving to their charities, they're giving to, all the people all the charities and things that they support ongoing. Well, instead of giving from your after-tax account, your checking or savings or something, make those gifts directly from your IRA. It's called a qualified charitable distribution. And you can literally give, like you tell your, whoever is holding that account, hey, send $1,000 to my church, send $1,000 to Red Cross, send whatever. And you've satisfied your RMD. If you do enough, you've satisfied your RMD, doesn't add to your income, and it goes straight to the charity anyway. So QCDs are what those are called. I highly recommend QCDs, looking at those. So those are a couple quick things for you, Lauren.
Okay, thank you.
You betcha, you betcha. Question in the chat: at what income does the bonus deduction phase out completely? I I'd have to look at the articles I've been studying on this. I don't know if I can ramble that off the top of my head. Bonus depreciation. If you're in a active business, they're more flexible than if you are passive. And it's not that there's a phase out, but you might have limitations on how much you can deduct. Let's see if I have my notes.
Okay, thank you.
You betcha, you betcha. Question in the chat: at what income does the bonus deduction phase out completely? I'd have to look at the articles I've been studying on this. I don't know if I can ramble that off the top of my head. Bonus depreciation. If you're in a active business, they're more flexible than if you are passive. And it's not that there's a phase out, but you might have limitations on how much you can deduct. Let's see if I have my notes on that. I don't have that in my notes right here. So James, if you want to send me an email, you've got my email, send me an email and I'll pull up more research on that and give you something more. Penny asks, was there anything in the new bill regarding capital gains when selling real estate, especially rental properties? Not necessarily directly that I've seen. I think what is mostly happening in those is the extension of opportunity zones. So if you haven't heard of opportunity zones before, it's something to at least learn about. What that is essentially, and opportunity zones can apply to a lot of things, but a lot of real estate investors use them, is you want to get out of this real estate investment, you got a lot of capital gains, and you don't want to pay 15 or 20% in capital gains taxes, and so you hold on to it forever. Well, instead of doing that, you can sell it, and if you roll the money into an opportunity zone, then there are categories within that new law, under the new tax law, the one big beautiful bill, that says if you hold that opportunity zone investment for 10 years, then your capital gain will be 0%. So that was one thing that's happening. Again, it's a little bit of a unique strategy. It's not complex. You just have to work with the right people to be able to find that, to be able to implement it, to be able to get it done. And then you are now reinvested into typically real estate. So, that may be a downside, but if you're willing to wait 10 years, then when you do liquidate from that second investment, the capital gains will be tax-free. So that's one of the things that I would say is relevant for real estate properties. Laura, does this all apply to tax year 2025 or does it start in 26? A lot of it starts this year. Some of it starts next year, like tax brackets. They were going to go up next year. Well, they've extended the tax brackets that were in this year, so that starts next year. Let's see. Bonus depreciation goes away in 2028. Is that right? I read that it's set permanent. If you saw something different, then I definitely want to see it. But the information I'm reading, that bonus depreciation for qualified business property was set to be permanent. But I know a number of the provisions are set to expire at the end of 2028. So if I missed that, James, I would love to see what you're looking at. All right, what other questions do we have? See, Janet, can you explain the rules regarding the $6,000 deduction as related to AGI? And can you reduce your AGI by making more contributions from your RMD? I don't know if I can explain it on the fly. I've read a bunch on this and I've done some sample calculations. And so I think I understand it completely, but to get everybody up to speed with your questions. So the first thing that I talked about, this bonus deduction, it does have a phase out rule. So if a single person, I believe, makes more than $75,000 and a married couple makes more than $150,000, then it starts to phase out this bonus deduction. And I don't yet have the math or the strategies in my head, but I definitely agree with you, Janet, that if you're in those categories for a single or married couple, above 75,000 or above 150,000, then yes, the timing of your income and the timing of your above the line deductions is going to matter so that you can influence the amount of your phase out on this bonus. So that is a planning opportunity right there, Janet. Yes, definitely. Let's see, who else? What else we got? All right. Any other questions? I think I'm managing the question thing correctly. I've never actually used it, the Q&A tool, before. Anybody else have questions about this or about anything else you've heard about the One Big Beautiful Bill? Yeah, Kathy, just unmute yourself. I don't think there's a way I can unmute you. No, there's not. If you can't, there you go.
There. Can you hear me now?
We gotcha.
Okay. I inherited my parents' house after they both passed. I would like my grandson to inherit the house. He's 34 right now. Now, do I absolutely need to wait till I'm gone for him to be able to inherit it without being punished by paying a lot of taxes? Or are there other ways, like maybe putting the house in both our names and then the house going to the surviving person? What would be the best way to?
Good question. Good question. I'll phrase it a little bit more generically, so we don't have to dig into more of your personal affairs, and I think it'll still answer your question. So the concept that I start from whenever the goal is to let somebody inherit is for everybody to know, when you leave something like a house or a business or even a stock or brokerage account to an heir, is that the current tax law says they inherit it with a new basis that's equal to the fair market value on the date of your death. So if I bought a house for $50,000 and it's worth $400,000 when I die, my heir will have the basis of $400,000. So if they turn around the next day and sell it for $400,000, they pay zero in capital gains taxes on that house. Okay, even if it's an investment property, doesn't matter. So that's called the step up in basis, and that's a huge advantage for people who are going to inherit something, is they essentially get that capital gain tax free. So whenever you change the title on something during your life, there's a risk that you've made a gift at that moment. And that's the difference between inheritance and gift law. So inheritance, you get a step up in basis as of the date of death. With a gift, there's no such thing. They receive the gift and they get your basis in that property. So whatever your basis was is now their basis. And so if they then sell it a day later, or they wait till after you pass and sell it, they now have the lower basis. There's no step up when you pass. So even adding them joint is still problematic, because now you've essentially made a gift of half of the property and they get basis of what you had for their half. So a joint, putting them on as joint, doesn't give them a good tax result. That actually gives them the worst possible tax result. So the way to potentially structure that would be, if you wanted to accelerate and give it to them now, is there's one type of trust you could give the house to. It's a very specialized trust. You give the house to it. They live in it now. And then when you pass, that type of trust gets a step up in basis based on your date of death fair market value. So there's not a lot of ways to do that other than to either own it yourself till you pass or put it in that kind of a trust now. So there's not a lot of ways around that. Okay.
What about a beneficiary deed?
Yep. It'll also step up in basis at your death to the fair market value. Yes, it will. Yes. So that is essentially inheriting at a beneficiary deed, even if they inherit it through probate or if they inherit it through your regular trust. But then it becomes theirs after your death. If there's a goal of getting it to them now, then the only real option is to create a specialized kind of trust. So it's something that I would say, if you want to talk more about that, grab a call with me. Let's talk about it so we can get into some more personal details when we're in a private setting, Kathy.
Okay.
Okay.
Thank you.
You bet. You bet. I've got a couple more minutes. I'll try to get through questions. Do business deductions apply to a family trust situation? If it's a business purchase and the business purchase qualifies under the tax rules, it can qualify, even owned under a trust. Yes. A lot of more specific questions to go along with that. But it potentially could. James, you can pop off or turn on your mic if you have a question.
I have turned it on, I believe. Can you hear me?
Yeah, good.
Okay. What I was asking about was the deduction, not the depreciation.
Oh, I'm sorry.
2028,
Yes.
and the early summaries of this big beautiful tax bill, that goes away in 2028's tax.
Yes.
$75,000 is the maximum for the $6,000 deduction, but you said you don't know where it goes to zero.
Yes.
Goes to zero. So anybody making more than 75 grand is less than $6,000 they can take out.
Yep, it starts to phase out at that point. And I have the information somewhere. I just didn't bring that with me today.
That's fine. I don't need to know the detail. I just wanted to make sure I understood what that was. And when it goes away, it's a beautiful thing, but it will die a sudden death.
Yeah, it's only here for a few years. So grab that deduction while you can and, sock away those tax savings for the future.
Okay.
All right, guys, I'm going to wrap us up. Thank you for joining. Good questions. If you have further questions about how this applies to you, don't hesitate. My calendar is open to you guys. It's right there in the chat.